Hello, I'm Donald Leggett and welcome to Share Views, brought to you by London South East. I'm joined today by Scott Aitken, who became the Chief Executive of AIM-listed Cabot Energy in June and releases his first set of interim results this morning. Cabot, as you know, are producing oil in Alberta, Canada, and have exploration interests in the Italian Adriatic. Welcome, Scott. It's great to have you here.
Thank you very much. Appreciate the opportunity to speak with you, Donald.
Yes, no, it's a pleasure. It's your first time in the studio as the CEO of Cabot Energy. So I suppose I should ask the difficult question first. Why the management change? What was that all about?
Well, Donald, the High Power Petroleum invested, as has many other investors in the business, for the attractiveness of the ability to grow production, light oil production in Canada with a high degree of predictability, and then with the very exciting upside potential in the unique Italian exploration prospects. Obviously, when we were monitoring our investment, we became concerned over some of the cost controls that were in place and the cost overruns, and that was limiting the ability of the company to optimise that production growth, in particular within Canada.
Okay. H2P bought 100% control of the Canadian assets in January 2018, and then you brought in a new senior team. So what difference did that make?
Well, for Cabot Energy plc, the immediate difference is accessing the increased cash flow by having ownership and control of 100% of the Canadian producing assets. And you can see that in the interim significant production volumes and net cash flow generated from the operations and EBITDA for the company. So that gave a broader base and a more efficient way to manage the company without a joint venture relationship. With High Power Petroleum then, in terms of management, we're deepening in particular the subsurface attention to detail and the workflows and the management of those workflows to generate the deliverables. That means going forward, we will have a much larger range of subsurface well targets to high grade from in Canada. And we're also focused on expressing the value of the prospects that we have in Italy that are highly material, and that we wish to see that programme advancing. So we've beefed up the organisation and the experience within subsurface, and in Italy we added a dedicated Italian-speaking resource to have a much more proactive engagement with the regulator and all the stakeholders in the Italian business.
So it's about workflow, it's about cash flow, and it's about speeding up the working through of the Adriatic licences.
Absolutely, and it goes without saying that those reporting control concerns that we had were a number one priority for us, and the CFO that we have brought in has great attention to detail and the commitment to driving those cost controls and the reporting and understanding of our operations from the field level all the way up to the board in a highly systematic way, but in a way that's easy for us to process the information and make decisions that will benefit not just the business, but the shareholder returns.
And it's a significant morning for you. It's your first set of interim results. To what extent do you feel these are your results, or are you actually inheriting the previous team's results? What difference do you think you've made, and what are the highlights of the results for you?
Well, clearly the period in review was 95% managed by the former management team, so that's a factual matter. What I can say with respect to the results is the confidence level we have is extremely high as a management team and also as representing shareholders. So the quality of the information, we have a high degree of confidence in. That allows us then to make the decisions going forward with a higher degree of confidence as well. In terms of what we would seek to highlight in those results would be the increased cash flow from operations and volumes that was yielded from the winter work programme. Clearly on the negative side, and we have to draw a line under, is the 40% budget overrun in those activities during the winter of last year and the spring of this year. However, they have delivered the production results that we had expected from the wells themselves. And so going forward, That is giving us a benchmark and a baseline of confidence in how the wells should perform, and therefore our focus is on well design to optimise cost, balance that with risk and production performance.
And what was the net exceptional of $3.6 million about? That's the number that stands out for me.
Yes. Non-recurring costs there, in the majority non-cash costs, related to restructuring, stock option awards and exercises, etc., related to the departing management team. The operational item that I would draw attention to is the $1.1 million of remediation that was undertaken at the end of last year, continuing through the spring of this year, for a salt water leak in one of the pipelines. And that precipitated a programme of benchmarking, baselining and recording the status of all the infrastructure that Cabot Energy owns and operates in Canada, such that these type of surprises are going to, we would expect to be not surprises in the future and proactively managed. And in fact, we are undertaking a facilities CPR as well as CPR for the subsurface assets. So we'll have a health check across the entire asset base in Canada, such that our budgeting going forward will be based on a more detailed understanding, knowledge and predictability of the operational infrastructure and the subsurface asset.
So no more surprises?
We are designing out as many surprises as we possibly can.
Okay. And 767 barrels per day is below previous guidance. I presume you're a little bit disappointed, a little bit frustrated, along with private investors. Tell me more.
Well, frustration is, of course, the very minimum that we would expect to be the emotional response. And in fact, the professional assessment of the performance is the same. Extremely frustrated as a shareholder and someone who sees a tremendous potential in the asset base. So our inability to have executed to plan was really the key driver of the change. The over-expenditure meant that capital expenditures for the second half of the year had to be viewed very carefully in terms of managing the balance sheet.
You can only spend money once.
Indeed, and unfortunately that money was expected to have been spent on additional activities to boost production. Now clearly those activities were not undertaken, but they were not undertaken for as a result just of balance sheet management issues. It was also a recognition that the detailed level of planning, both from subsurface targeting of the best locations and also the well design and delivery process, was really not at the level of robustness that we felt was appropriate, and we would prefer to have taken the difficult decision of disappointing all stakeholders by shutting down the summer work programme, such that when we restart it's from the basis of a much more highly confident position. And I think you'll see this flowing through from the competent persons reports that will be published through October.
Which takes us very nicely to your strategic, operational and financial review. What have you discovered, and what are you going to be rolling out into the business?
Well, the underlying assets, first and foremost, we remain very enthusiastic about. I'm talking about our ability to predictably grow light oil production with high netbacks in Canada, and our ability to unlock 1 billion barrels of prospects in Italy, where we have a very attractive fiscal environment. So we remain strategically very enthusiastic about that. What did we change? We focused in particular on subsurface management, workflows and deliverables, as I mentioned already, and also the more robust reporting and controls at the operational level, enabling better decisions to be made at the board level. That then informs our financial capacity planning going forward, such that the work programmes we execute next year are going to deliver what shareholders would expect.
Is this work in progress? Have you started to actually implement these different changes as part of the review?
Indeed. So the workflows from a subsurface perspective are fully embedded now, and we'll see the results of that in our competent persons report through October. Building on it down to the practicalities of generating the high grading of the well targets. We have a medium-term target of generating 100 well locations from our existing land base within Canada. We are acquiring further, we're purchasing existing 3D data to give us a much more overall understanding of the land position, so that the well locations that are worked up and high graded are in fact the sweet spots that deliver the best returns to the shareholders. So we'll work from an inventory in the medium term of 100 wells, and we will seek to drill 10 new wells next year from a planning perspective, subject to managing the budget. And then from a perspective in Italy, we are moving forward the 3D seismic acquisition program. In fact, we're tendering for in a joint program with an adjacent operator as we speak, to be able to drive down the costs. And then in terms of the financial systems and processes, we have already implemented procurement to payment system, so end-to-end tracking of our cost base, starting from a zero-based situation. So every expenditure, particularly in the Canadian operation, has to be justified, goes through our procurement manager, supply chain system. So that's implemented. And then in terms of our ability to understand our burdens in terms of royalties, where there is an attractive but sophisticated royalty environment within Canada, we have implemented the same system that the independent competent persons report auditors use. So we will have complete consistency. So in many areas financially, we have moved away from a manual spreadsheet approach to a much more systemized approach, with no net increase in headcount for doing so. So increasing robustness, quality of information with no net increase in cost.
Which takes us to the farm outs that you're announcing in Italy. This is very exciting news. Perhaps the best way of approaching it might be to explain what the Adriatic assets are, and then your plans for them.
Well, there has been historically a significant focus on the Adriatic assets, and generally the Cabot has the leading exploration license position of the foreign participants, and so that is an attractive position to start with. The Adriatic has the single largest prospect, we call Cygnus, 401 million barrel P mean prospect in the adjacent license to an existing producing field operated by Eni. Proven petroleum basin, discoveries in the license, and a very attractive world-scale target there. So that gets a lot of focus. But
so
we already
do you regard that as exploration or exploration verging on production?
No, we would have to categorise that as exploration to be transparent with our stakeholders. We also have a very leading licence position in the Sicily Channel as well, where we have a 225 million barrel P mean exploration prospect target, which is an adjacent to, again, an existing producing infrastructure. So proven petroleum basin with a highly attractive exploration prospect. And our ability to find farm-in partners has been proven by the previous farm-in by Shell in our Po Valley exploration licence. Again, adjacent to existing infrastructure, and a 200 million barrel field that has produced 200 million barrels. So again, proven petroleum basin and high graded within the Po Valley. And we have a 54 million euro seismic and drilling carry from Shell Italia in the Po Valley. So across this portfolio, we want to express to investors, we see that there is upside, not just in the Adriatic, but we have 3 world-scale prospects, multi-100 million barrel prospects in the portfolio in each of those basins. And we have a carried position in one, and in the other 2 we have commenced farm-out negotiations to fund the entire drilling cost of the Sicily Channel and the Adriatic prospects.
So you're actually looking for someone else to actually take on the entire cost of the programme?
Absolutely. For the balance sheet that we are managing within Cabot Energy, it makes sense to leverage third-party capital at the asset level there, whilst retaining the maximum possible interest at the end of the farm-out process.
It sounds like a great deal if you can make it happen.
Absolutely. So our job is to make it happen, and clearly it has not happened yet.
Okay. My final question, if you could pull together everything, all the different strands of what you told me today, and sum up the outlook, sum up the investment case for Cabot Energy going forwards.
So I think the investment case is that we're going to generate predictable production growth going forward in Canada, light oil with very attractive netbacks in a position that we 100% own and operate, high degree of controllability. We've deepened the robustness of our ability to deliver that through management change and through deeper processes, subsurface understanding and systems in place. That's the predictable production growth. But the differentiator that we have within Cabot Energy is our world-scale exploration upside position within Italy. It's the leading exploration position within Italy. World-leading fiscal terms and prospect sizes. The difference that we wish to make to that is actually driving it forward in a proactive manner with all the stakeholders, the regulators, and with joint venture partners, such that we turn that from potential into drilling events. Very focused on turning it into drilling events. That will yield ultimately value or no value. But as a paper asset, it's not valuable. These prospects must be drilled, and that's management's real focus, which will generate many hundreds of millions of dollars, potentially billions of dollars of value in the success case. So we have to focus on getting them drilled.
What kind of timescale do you give yourself?
We've given ourselves a timescale of drilling events within 36 months.
Okay, and that's it for now. Thanks very much to Scott Aitken, CEO of Cabot Energy, for being with us today. It was a fascinating discussion, and don't forget to subscribe to the London South East YouTube channel if you want to see more interviews like this one. Thank you for joining us.